Hello friends, my name is Vijay Chilka. I am from Altiport Funds. So this is our show, Ask the Expert Show, where we will introduce new products which are suitable for our clients, looking out for investments in AIFs and PMS. So today we have come up with a very interesting AIF, which is in a credit fund from AK Bonds. And to join, we have Mr. Vikas Jain, CEO of AK Bonds, who will explaining us about this fund in detail. So we will discuss why these funds are important, who is the target audience, what is the investment style, and what is the expected return, what kind of a regular income we can expect from this fund. All these things will be covered by Vikas Jain. And to brief about Vikas Jain, he is a CEO of AK Bonds with last 24 years. He has completed his chartered accountancy and he from ICFI and NSM certified in alternate investment fund manager. He is in the business development in private sector companies, in the mid-market companies and debt resources. He has a key successful understanding needs on credit evaluation, structuring, fundraising, and he is aligned with the investor risk appetite. He has a robust knowledge in the capital markets and instruments. At AK Bond, he has done several hats like handle retirement funds, advising venture debt funds, advising of various instruments, as well as fundraising. So, welcome Vikas ji, and we would like to hear, and our clients want to hear, exactly what these funds will be and whom will be the best suited for them. Over to you, sir.
Thank you, Vijay. Thanks for this quick introduction and good afternoon to the entire team of Altiport. And thank you for taking out time. So I'll keep it crisp. I think on half an hour I'll try, and thereafter we can quickly move on to the Q&A. Right. So I'll keep it very crisp. Right. One, I think yes. To kind of just add to what Vijay said, right? It's been a 25 years journey with the AK Capital Group. Just stepping back about just some pointers for AK Capital Group. One of the most vintage house in the debt capital market. So we got our existence came into being in 1998 when we got our category 1 license, and since then till now we focused on the fixed income capital market, that's the debt capital market. So among the only few to have a vintage of more than 25 years with a focused approach in debt capital market. Friends, I think the outcome, the advantage that we actually saw by just being focused on the fixed income is, I think we got a lot more deeper in our business coverage. That means we are possibly the only one whose every vertical will compete with different set of competitors. So we deal in PSU bonds, which will have a different set of competitors. We deal with state government guarantee and municipal corporations. In fact, we've already taken a substantial lead in getting municipal corporations to the bond market, and you'll see a lot of them available in the secondary market as well. So we are practically the leader there as well. So that competes with a separate set of competitors. When it comes to private sector, high rated. When I say high rated, it's typically double. Very simply put, it's double A rated and above. There we have banks competing with us. And then when we come to credits, which are typically, the way I would define it is anything which is rated double A and below and comes in from private sector, right? It's a very simplistic way, right, to kind of define anything which is less than double A and non-sovereign. That means they are private sector issuers. They need to be evaluated, right, to whom to give the money and at what rate to give the money. And that folds into me over the last 15 years. So I've been a more credit guy over the last 15 years. The initial 10 years of the journey was handling retirement funds. But the last 15 years, I've been focusing on the credit, which is double A and below private sector credits. So that's about AK. Again, two bits on AK Group. As I told you, we hardly see that kind of vintage with a focus in the debt capital market. And that gives us a strength, right? Because we would have typically navigated some 4 to 6 cycles of interest rates and credit movements over our journey of more than 25 years. The second important part is IFR Asia, which typically also every year picks up a bond house and a loan house at the international level from every country, has awarded AK Group twice, to one 2018 and 2023. It's like an Oscar. It's equivalent to like an Oscar, right, for the debt market. And we are among the one to have awarded twice this IFR Asia Bond House of the Year award from IFR Asia. One more important piece and very relevant from the alternate funds product that we're going to be discussing today, the debt alternate fund, is friends, I think a lot of it has to do with the experience, not just like as a merchant banker, but also as a fund manager. Correct. So merchant bankers are typically matchmakers, right? And if fund management is if you are able to manage your own funds in the same asset class. So one more input, and we're going to cover that in the presentation, is that AK has been managing over the last 15 years their own NBFC in credit papers. That means double A and below credit papers for last 15 years with practically zero NPA. So we've seen 3 cycles of credit cycles with about 3,500 crore worth of AUM in our NBFC arm, which is more like a prop book for us, correct? And we've not seen we losing capital in any of the instance while we were dealing in high yield papers, right? So I think that this fund gets backed by the track record, the focused track record of AK Capital Group being focused on the debt capital market of more than 25 years. It is also backed up with an experience of more than 15 years in debt fund management for about 3,500 crore of an AUM as we speak today. And it's also a recipient of IFR Asia Award, which is twice, which is one of the most prestigious awards internationally. So these are basic things. I've told you about myself last 25 years, and I'll quickly move on to the product. And happy to kind of take questions once we are through with the presentation. Just give me a minute to think of it. Vijay, do you see the screen visible with the slide? First slide is AK Emerging Credit Opportunity.
Yes, we can see the screen.
So I'm presuming everybody else would be able to see it across. So quickly on to the product. Now, before I just go into the product, right, I think the first important question that we always say, right, and I'll come to that, right, is why performing credit fund now? Correct. So just very small 4 pillars, right? Today we all know you've been working with credit equity funds, right? One thematic thing, right, that has always been told to you is the corporate health. Corporate health is much better than what it was possibly like 8 to 10 years back. That means they are much more low leveraged than what was 10 years above. Now, the outcome of that is their debt ratios are much better for servicing debt, right? So they are much better debt health. Interest rates seems to be peaked out, right? We will see GSEC moving about 15 basis point, but you've already seen repo rates cut happening. People are not speaking about the rates going up, right? So we presumably are near to the top. So it makes sense. And the yields that are offered in the industry are ranging from 11 to 12.5, and this is I'm speaking only about performing credit, and I'll come to also speak about what is a performing credit. So sound corporate health, attractive spread, interest rates at the top makes a good sense. And as we understand from a lot of the equity players, that large caps or large cap index funds are projected to be around 11 12 13% steady state over the next 2-3 years, right? Which means, right, that the credit funds are very near to what a typical large cap or a large cap ETF, right, typically would look like in terms of return. But this comes in as not market linked. That means this is a lot more certain returns than the market return. So I think this is where, if you see the market picking up, and we see a lot of private credit funds garnering good amount of funds, right, is a combination of these four things. Friends, now coming on to the debt R fund. So before I start, it is a category 2 fund. So just for the sake of understanding for a lot of our partner managers, is that today Cat 1 fund is more towards angel funding or venture capital funding. Cat 3 fund are more hedge funds, correct? That means they are high trading strategies, which is Cat 3. Cat 1 is venture funds, and anything which is not a Cat 1 and Cat 3 typically falls in as Cat 2. So you will see almost 80% of the funds, be it equity or be it debt, are launched under the Cat 2 category, because either they are not venture, they are not trading strategy, then they'll typically come in under the Cat 2. Cat 2 is a pass-through entity. That means the fund does not pay tax on the income that the category 2 generates. It only withholds TDS, which is about 10%, correct? The investor pays the tax as if he received the income directly. That means in his return filing, he will typically pay the tax as per his applicable slab. Very simply put, had he directly invested in bonds, and if he's investing through a category 2 debt fund, the taxation is absolutely same. Okay, so this is like a very small glimpse on category 2 fund. They are registered with SEBI. So what we're launching is our third fund, right? And I'll speak to you about the first two fund performance as well. But this is the third alternate debt fund. It is a performing credit fund backed up by AK Capital Group. Philosophy, we've kept it very simple. Now, friends, you will come across a lot of questions that people are saying that anywhere between 13 to 18% is being marketed as performing credit. Now, that's something that, friends, you will get to understand from the market. Again, please don't take me wrong. We are not here to say what is wrong, what is good or bad. We're just trying to say what is performing credit and what should not generally be, as per my personal opinion, not be a performing credit. I'll give you a very simple example. If let's assume, I just take an example saying that, look, there is a company called Cholamandalam Investment and Finance, right? Or any operating company for that matter. Let's take it. But let's assume, because it's a group backed, I just took that name. I'm saying if Chola Investment and Finance company borrows on their operating company, correct, it will typically borrow at anywhere between 7.5 to 8%. Correct. It's a AA plus rated entity. Correct. But the same group's holding company, correct, the holding company of Cholamandalam Investment will at least borrow 2 to 3% costlier. Correct. Now, whether it is performing credit, yes, the group is performing. Correct. So it can be termed as performing credit. But as per me, the most simplistic definition will be that if the money is lent to the operating company, that means the repayment is also coming in from the operating cash flow, is for me that is performing. This is my 15 years of experience, that the risk of the holding company, see, because any holding company will not have cash flows. They are dependent on cash flows from their operating companies. That means if there is a debt which is given to the holding company or the promoter company, right, the only way it can get service is by refinance or by monetizing its equity shares. That means the business is not going to pay it back. Simple. So I think we've kept a very simple definition that, and this is a relevant point, that whenever you are marketing funds, right, the simplistic way to kind of distinguish between a performing credit and a structured product fund, correct, is typically, are you lending majorly to the operating companies or non-operating companies? It's a very simple line. So friends, definitely these are very different risk to return parameters. Again, as I told you, I'm not classifying anything which is a good or bad. It all depends upon what's the level of risk your investor would typically want to take. But by normal logic, an operating company focus will carry lower risk relatively than an holdco kind of funding. Correct. So that's one very important piece, because you will see a wide range of yields coming in across in the market, right? And it all depends upon what's the risk to the reward return, right? So we both our earlier funds were operating company focus, and this fund continues to be in operating company focus, right? So predominant investments are given to businesses directly which are generating cash flow. That means the repayments are coming in not from any monetizing event, it is coming in from the business cash flow. As simple, right? Now we obviously because we understand this debt market, and just to kind of also add to the team members team, we also run one of the largest direct D2C tech platform of bond market, right? Or the online bond market, which is indiabonds.com, and a lot of people would have heard that name as well. That belongs to the same promoter group, right? indiabonds.com, and that's more like a stock exchange. I mean, obviously we can't run a stock exchange, but online bond platform is one of the largest in India. So we understand this debt market, and that also establishes our secondary market presence, right? We are among the very few to have a very active secondary market. Now, how does it help in my alternate fund? The third fund, there was between the first two fund and the third fund, there was one regulatory change which happened, right? Which was based on our pursuance, right, with the authorities, that in all the category 2 funds are required to primarily, that means more than 50% has to be in unlisted securities. Now, for debt funds, the regulator has aligned that there are many equity unlisted company, but still doing listed debt. Correct? That means their equity can still be private, but they are doing listed debt, right? So that's the change, and we're going to capitalize that, because that's again a key strength. As I told you, last 15 years, our prop NBFC is about a 3,500 crore plus AUM, and that has been dealing predominantly in only bonds, correct, and listed bonds. Now, the beauty of listed bonds is that more than 1 year, the interest is taxed as per the slab of the investors. But if you generate capital gain, that means if a 100 rupee bond sells at 102 rupees, right? Again, I'm repeating, the coupon is taxed at the slab rate. Let's assume a 100 rupee bond has a 12% coupon. The 12 gets taxed at the slab rate. But if it is downsold at 100 rupee bond is downsold at 102, and it is a listed bond, and after 1 year, it is taxed at 12.5% plus surcharge, not at 39%. Correct. That means this fund, the third fund, what we are going to guide is only the interest that you're going to get. There is a potential of capital gains, which is long-term capital gains, which is over and above. Obviously, we can't put a number to it. We can only say an expectation, but that is because our own strength is also to deal in listed NCDs. Correct. Now, one more important part, listed NCDs from a governance standpoint of view, right, is also better, because there are a lot of disclosures because of it being listed on the stock exchange that a company is required to make, right? That means information is also available publicly. Okay, so that's one change from our first two funds, because this is a recent regulatory change. This was basically our pursuance, right? And up to A rating category for a Cat 2 debt fund, they've allowed it to run 100% listed. I'm not saying that we will do 100% listed, but a predominant portion will be focused towards listed bonds. In any case, we don't do unrated bonds. That means we always do investment grade and above rated. So now it'll be rated as well as listed. Okay, now it's a 4-year close-ended fund. 500 crore is the target size. So and 13.5 is the gross IRR, and the net IRR sheet I will take it up at towards the end. Principal will come out over the last 3 to 4 months. Interest is being serviced quarterly basis. We've spoken about this, friends. AK Group, the largest in the public issuance of debt. On a private placement, we almost raised 4 lakh crore annually. That means this entire market, which is about 11 to 12 lakh, in fact, it will close about at 12 lakh crore. That means 12 lakh crore worth of bonds are issued every year, including PSUs, including private sector, including municipals and states. We participate in almost 3.9 lakh crore. Out of it is almost 46% market share. So we are one of the largest manufacturer of bonds. And that also benefits the alternate fund because there's no leakage of yield. Correct. We're there since 1998, IFR award we spoke about. And this entire AMC is working in very close synergy with the group. That means, why is it important that this AMC is not a standalone AMC? Because in the debt market, our experience has been that if you know your borrower well, if you have a better control on your borrower by whatever means, it does lead to a lower credit cost. Which essentially means that if we are synergizing with the group, that means if the group is not comfortable with dealing with a certain set of borrowers, the AIF will never invest there. Correct. And that's the synergy that I'm speaking about. Deal sourcing is all direct. We don't rely on intermediation because, as I told you, we are one of the largest merchant banker in the debt house. So we don't need to rely on any deals. In fact, we structure a deal that we want rather than what is available in the market. Correct. Structuring is all in-house. My personal experience of last about 15 years has been in credit underwriting. So I'm only leading this vertical from a credit perspective. Very strong monitoring team, and we will again showcase what is the outcome of the early warning signal. People have been speaking about early warning signal. Friends, I want to tell you, as we come on to the slides of first fund and the second fund, we actually made premature exits, two in each of the fund, much before the distress actually showed out. That means actionably, this has proven us right on both the funds that we've been able to exit much early than the stress actually showed up. And timely exit, because of our presence in the secondary market, friends, I think we are more capable to downsell our exposures if it is required to, though it's a closed-ended fund. It is a passive investment strategy, but in case, as I told you, that we're going to be focusing on listed bonds, that's why it makes a lot of sense. Secondary market experience in any case is one of the largest in the secondary market. Now, very quickly on the first fund, this was a 2022 vintage when the interest rates had not started moving up. So in fact, we launched it in early 2022 and the interest rates started moving up from mid 2022. So March, April 2022. So this was guided as 12% net gross and about 9.75 net, correct, to the investors. Friends, this funds has fully rotated and returned the entire capital 1 month before its maturity with an outperformance of 200 basis points. That means this first fund has already been returned back to all of our investors in a timely manner with an outperformance. Okay, now very important, I think I would want you all to look at this slide. See, the fifth point from where it says it is AA- rated. Now, see, again, there is one question that you're going to face right from your investors is whether a 13% is the right yield, whether 14% is the right yield, whether 15% is the right yield. Correct? That's a very normal question that any of your RMs will come in, whether हमें नहीं पता ये 12% सही है, whether 13 is right, 12.5 is right. I think while rating does give you a benchmark of the yield, I'm not saying that's my underwriting condition, but a rating, because we deal in bonds, what we felt was that if I get the units rated, correct, that means the units that are being invested by the investors, if we get it rated from a rating agency, then they will have a perspective. See, today I'm just stepping back. When you are investing in a Tata Capital bond, you know it is a AAA rated bond, and that's why 7% is the right rate. If you're investing in a AA rated paper, that's why 8% is the right rate. Correct? That means you actually have a benchmark, right, to see whether the yields are right or not. Now, our first fund, after we were fully deployed, we got our, this is voluntarily, this was not mandatory by law. We got the units rated, it was rated AA-. Now, friends, you will have a perspective. Now, when we launched the fund in 2022, a AA- 3.5 year paper was available at 875 to 9 quarter. That means investor had a choice of investing a AA- paper in early 2022 at 875 to 9 quarter. They invested in our fund, which was a similar risk of AA-, and we've delivered them between 1075 to 11 quarter net. Correct. Now, if I remove this rating, it will always be a guesswork whether 1075 or 11 quarter is the right price that I got or not. Correct. So what I'm trying to say is that we will be getting our funds rated after we are fully deployed. As we speak, my second fund rating is also under process and it will be also AA minus. But I'm saying this gives, the only objective is it gives a perspective whether the yield is right or not. The second fund was about was a 24 vintage. We closed it in early 25, and that it's a 4-year fund of which 2 years has already passed by and 2 years is remaining. One more input: the fund maturity is counted from the first closing. Now this is also a regulatory change in Cat 2 which has happened. Correct. Now earlier final close, jab hum finally we used to close the fund, the tenure used to start from there. Now when the fund announces the first close, the tenure is counted from there. Correct. So this fund has a 27 maturity, and it was the first closure happened in late almost 23 end. Correct. That's why the maturity is 2 years have passed by. There is pending of 2 more years. One more important part, if you see, we did about 22 investments in the second fund, and we've done similar investments in about 2021 company. That means we are diversifying with an average of less than 5%. Correct. With about 7 to 10% max cap in a single company. That's more to achieve the capital protection. Correct. But the unique part is, between the first funds about 20 investment and the second fund 22 investment, there was no repetition of names. Now that shows the origination strength of the group. We did not have to repeat borrowers right over our funds, and that's been the strength because we are directly the originator. Correct. Now how does this number comes in? Why? I mean, when we speak about this 7%, it is very fund specific. If there is no default, that means I am assuming, while I'll still repeat, in none of our funds there has not been a single rupee delay even for 1 day, neither in our prop book of 15 years and neither in our funds. But when we structure the funds, we go with a what if scenario. Right? Now what if says is that if the top exposure defaults and I don't recover anything, right, then also the investors will get between 775 to 985. They will get principal plus 775 to 985. If top 2 default happens with 0 recovery, correct, that means they will still earn about saving bank interest with the principal. That means at any worst case also the principal is protected. When and this is a mathematical number that we say what if scenario, right? And that's why if you see our fund 2 based on the fund investment has capped themselves at 7%. That means they will not go more than 7% in any one single company. Correct. So that's the mathematical formula. So this is a 14% guidance, and we are currently running a 14.2. As I told you, friends, right? 2 years have already passed by, and there's 2 more years left pending here. Spoken about this performing credit versus structured credit, right? So essentially, this is the handle, right, that we've already spoken about. Again, a quick glance: 500 crore. The sponsor skin in the game is 5%. That means on a 500 crore, we'll be putting in our own 25 crores. The regulatory requirement is just 5 crores. So we are actually doing 5 times of the regulatory requirement as the skin in the game from the sponsor. It's a 13 to 13 and a half, but our target will be to cross the 13 and a half between both the funds. So we're just conservatively saying 13 and a half. Friends, there is no carry year. There are only 2 head of expenses, and we are again we say it with pride, saying that we are one of the most competitive when it comes to management fee as well as the expense. Correct. And we don't have carried interest in any of our schemes. Correct. There is no profit sharing. That means there are only 2 heads of expense: management fee and operating expense. Our management fee slabbed out from 1.5%, and I'll come to that as the last part. And the OPEX is capped at 25, but it's expected to run between 15 to 18 basis. That's the only 2 expense. There is no carry. Whatever is the residual is of the investors. So we are one of the most competitive when it comes to expense ratio, also on the management fee side. Correct. We are expecting, well, we've already announced the first close at about 100 crores in this fund because this is already launched. We already have 60 investors who've already committed about 100 crores. It was launched post Diwali, and we've already seen a first closure. The fund remains open. At drawdown we are taking down 10%, and again we are expecting the full drawdown within just 6 to 7 months. A lot of our peers are taking at least 12 to 15 months to draw down. Correct. So we will be drawing down within 6 to 7 months. That means by July, we should be able to draw down full. The fund remains open for subscription. The only thing is, if you have drawn down 50% from my earlier investor, the new incoming investor has to pay me upfront 50%. We've spoken about these are operating companies, they are vintage, they are proven models, that just that they are regional players. Correct. So it is an operating company focus part. And friend, there is securitization also, which is called PTCs, that we are carving out about 15%, right? I just to very simply put is that DHFL, once they defaulted on the balance sheet, their PTC continued to remain AAA. That means the asset was moved into a different SPV, and the investors were serviced from that SPV, which did not have any other liability other than the assets. Now, this is a 2 lakh crore annual market, and it is proven, right, that if you have to diversify from a balance sheet risk perspective, this is the best way to kind of diversify, because PTC diversifies your balance sheet risk. So we're carving out 15% for that. Again, this is an instrument, right, that we do a lot of work from our merchant banking as well. So this is simply what we've spoken about. Financial sector would be a focus about. So friends, we've not changed any strategies from the first, second, and the third fund, because it's playing beautifully well for us, right? We've never seen a single delay in any of our funds. We only see rating upgrades, and that speaks about that we understand this sector, because we are a little more financial services focused for a simple reason, that we feel that the group understands the control over the mid-market financial services companies are much better. Correct. And one, as an input, just from a factual updation, over the last 12 months, whatever name that you've seen that has gone into a little bit of a distress in financial services sector, the fund did not hold any of them. Now that speaks about our capability to either exit in time or not to enter at all. Correct. And I was speaking about exit, and I'll come to that we've exited 2 positions in my fund 1 and as well as fund 2 almost a year before the distress actually played out. Correct. So for want of a better line, I think our fund 2 has seen the most volatile time in the financial services sector, and 90% of the pain is behind us, and there has been no delay and only rating upgrades in our fund. And we are speaking about 22 investments. So it is performed in the most volatile period of time. Right. So that's the best way, right? I think if the fund performs in the most volatile period of time, we feel, I think the strategy, the synergy is working fine for us. Again, similar 4 to 5% of an average, 20 to 30 investments, 7 to 10%, right, of a cap in a single investee company. And the investment committee, the group has a clear oversight on whatever the AMC is investing. Again, to kind of prove in from the synergy perspective, Aditi and Mr. Bakshi. Mr. Bakshi is the chairman of the IC, is an ex-banker with extensive experience, right, in the credit market itself. And Aditi is a market face. She guides on the pricing and the view of the promoters of the credit market investments. I am there along with the team, leading as a CEO and CIO. Very quickly, we've spoken about the most important part in a debt strategy vis-a-vis an equity strategy. Equity is a fund manager, right? Skill. Debt has always been an AMC. It has to be a team, right? So a 25 year of an experience of AK Capital Group in the debt capital market, more than 3,500 crore worth of AUM that we've managed in our prop, right, NBFC of for similar credits. My experience of more than 25 years. This is the third fund from the group. The first fund is fully returned back with outperformance, right? And of the 40 investments, 20 has seen rating upgrades by one or more rating notches. And we've not seen any single rupee delay from their scheduled repayment, from the scheduled date, not even a single rupee, single day delay in any of our funds, right? Of the 40 investments, and we're currently already managing 250 investors. This is the slab I spoke about. 1.5% if somebody is less than 5 crore, going up to 1% if it is 20 crore and above. So as I told you, friends, it's management fee and about 18 to 20 basis point of operating expense. There is no other expense head. Open for question. I will just halt here, and one more is on the yield side. Let me just kind of just a minute.
So I have one question.
Yeah.
So what is the total addressable market size of this debt instrument compared to the equity market?
Okay. So let me put something on numbers. As I told you, typically the entire issuance, primary issuance market will be typically ending at about 12 lakh crore annually. That means almost new debt of 12 lakh crores, right, is being raised across the rating curve, right, from PSUs till the triple B or the investment grade rating. Correct. If I have to say that the total debt market, right, the total debt market outstanding wise, about 20%. See, it's still dominated by GSEC because GSEC and state development loans, which are sovereign securities, which are nothing but borrowing of the state government, still takes up about 70-75%. 24-25% of it is corporate bond market of the entire debt outstanding. Pardon me, I can't hear you.
75% is a GSEC and 25% is
Very
a
simply put across, right? Because still state development loans and GSECs and treasury bills typically occupy the maximum space because government is still the largest borrower in the debt market. Correct. But corporate bonds have moved from almost 13 to 14% almost 10 years back to about 24%. So that CAGR is good, right? They're growing about 12 to 15% from a outstanding perspective, the corporate bond market. Yeah, sorry, I can't hear you again.
So in the last 10 years, the CAGR for the corporate bonds are already growing by 12%.
15%, yes, easily.
And what the total size will be around 12,000 crores, what is it, for the GSEC and
No,
corporate?
no, it's
Together?
12,000. It'll be much larger, boss. It'll be much larger, right?
12,000 crores only for the 25% of corporate bonds, you want to say?
Yeah, so I'm saying if you're speaking about the overall, the total debt outstanding market, right? In dollar trillion terms, it will be near about $3 trillion.
Okay.
Okay, so it's correct. It's a very large market.
It's a very
And
large
25%
market.
from yeah, it's a very large market. It's a very large.
So
So
if a person who want to invest in equity and debt, so ideally what should be its allocation towards debt instrument?
see, see, historically, and Vijay, just correct me if I'm wrong, because y'all are also handling directly the HNIs and the family offices, right? Even if I have to speak to a lot of our partners, still India about 60% ranging from 50 to all as high as 75% has been a debt strategy in anybody, right? Almost 60, 50, 60% from a lot of family offices in HNI. If I'm speaking about more family offices as well, correct? They will have a 50%. But earlier, obviously, it was mutual funds, right? Because the tax advantage was there, right? Now the tax advantage is not there, right? And thereafter, the equity rally obviously pulled in a lot of money, right? Of the incremental money that was going in. It's only recent times, right, that they've said that look, debt mutual fund typically is about 6 to 7% of a return because they only concentrate on AAA and AA plus, very high rated, very liquid paper because which they've always been running a T+1 liability, right? That means investor can go and ask money at a 1 day interval. So the only obvious choice for any fund manager is right to invest in very liquid papers. If the redemption comes in, right, then he will honor those redemptions. That the close-ended nature of these funds have allowed all the fund managers to take reasonable risk, right? Now, very simply put, right, a mid-market risk need not necessarily be a wrong risk, right? Because they are still vintage. They are businesses, they are regional businesses. Over 15-year, 20-year history, they were never delayed any repayments, correct? But it is their choice that they want to be a regional player, correct? Now, credit funds typically, I mean, our funds will typically look at these regional players. And one more important point for the team, which I in fact missed out. Almost 90% plus of my customer has bank as a lender. That means they are bankable customer. It's just that the bank are not fulfilling their full requirement, right? In fact, that's the point. That's there in the presentation also, that one of our criteria is that we want to see the banks in their borrowing profile. That means they need to be a bankable customer. Correct. So coming to your point, one, between the debt mutual fund, the alternate fund typically will be about 400 to 600 basis point higher than what typically a debt mutual fund will be there. Correct. And this need not necessarily be very high risk. It is still conservative because we are more concentrating on regional players, operating companies, bankable customer, not getting full funding from banking. Correct. And that's the reason why if you see this chart, which you can see the chart, right? 11 quarter to 12%, right? Is that this chart visible, Vijay? Yeah, sorry,
Yeah,
I
it's
can't.
visible. Yeah, it's visible.
Yeah, so this is the net return. Guys, when we speak about 13.5, it's the gross return. There are expenses and thereafter there is a net return. We are very conservatively you will always find AK as a group that we will always be conservative. So we've said that the median of the 13 to 13.5 is 13 quarter, right? So we've been conservatively saying even if it is 13 quarter, it will be 11 quarter to 12% annualized yield net returns after all of the expense to the investors, depending upon which slab he puts in.
And the returns which you showed is like net of all the charges.
This is the one, the last one, which is the 11 quarter to 11 half, 11 half to 11.75, right, are the net returns.
Okay. And
So we'll share you this sheet as well.
yeah, and the payout will be happening on a quarterly basis, right?
On a quarterly basis, yes.
Okay. And currently, if anybody want to invest, they need to invest 50% as a drawdown.
No, we are only taking 10% right now, Vijay. See,
Okay.
at the time of but one disclaimer here, because if I draw down, let's assume your investor comes in after 1 month.
Okay.
Right, wants to come in after 1 month, and by that time I have drawn down from my earlier investors additionally 40%, which I'm going to do, correct? Then the new investor, because SEBI does not allow us to draw down just 10% from one of them and 50% from others. Everybody has to be same.
Okay.
To keep it very simple, right, it will be anywhere between 10 to possibly like a 35%, because by the time January end, I am myself estimating that I would have drawn down additionally at least 25 to 30% more.
Okay. The total 35% by end of the January.
Jan.
And the companies which you are investing in, right? So as you said, they are the working companies. Indian
operating
companies
company.
with a lower risk.
Correct.
But what is the rating, minimum
They'll be
rating,
all investment grade and above. They'll be all investment grade and above rated.
investment grade and above?
Yeah.
And number of companies that they're investing in the third series?
Will be about 20 to 25 companies. The strategy remains the same. We move towards the 5% average. That means minimum 20 companies I'll do by the time I've done the final close.
So at every tranche, the number of companies will be adding, or
Yeah, we will be adding, right? Because what will happen otherwise, I will end up giving a very small ticket size, right, to
Hmm.
20 companies. So when we say 20 companies plus, it will be by the time it is final close. The final close is at least 6 to 7 months from today.
Okay. So currently, how many companies we have invested in third
In
series?
the fund one and fund two put together, more than 40 companies.
No, in the third series,
No,
till
no. So third
now.
series, we have just in December, we've announced the first close. We've just done a drawdown of 10%.
Okay.
By 15th of January, we would start investing, right? In fact, we will be sharing the portfolio details as well. But initially, it will be just one investment, right? Because as I draw down, I'll build up the number of companies.
Okay. Okay. So ideally, if a person, just to give an example, has 10 crores of coppers to invest in
Correct.
equity, bonds, and all other across the asset class.
Correct.
So, and suppose if a client has an age of around 50 and 50 plus,
Understand.
so
Understand.
what should be the ideal allocation towards any of the debt fund?
So I think because these are close-ended, and if you say the age is 50 and plus, right? I would suggest I think it should be not more than 10 to 15%, right, of his total corpus going into debt alternate funds.
Oh, and as we are the market leaders, right? As you said,
Yeah.
so holding around 45% of the market share in the debt market.
Yes, in the primary debt market, correct.
Okay, okay. And one more interesting, as you said in your PPT, that uh, India bond is also part of your organization.
Yes.
So most of the this product will be suitable for the family offices or the individual investor.
Yeah. So I'll tell you my experience in the both in the fund one and fund two and fund three, as I told you, because we are a little more conservative when it comes to debt risk, right? See, our firm belief is right that it doesn't make sense, right, to become a tiger for 2 more percent.
Hmm.
Correct. Because the 2-3% additional delta is going to take us to taking much higher risk, right? I start taking 16, 17, 18%. And
Hmm.
friends, let's be very clear, right? Higher the interest rate, higher the risk. I mean, there is no other story other than that, right? If
Yes.
somebody is paying 18%, then 18% is a high risk, right? You can't get justified saying that it is opportunistic, right? As an
Hmm.
18%. My simple point is because we are conservative, right? And the range is anywhere about 13 and a half, which is about 11.5 to 12% net return. It becomes a lot more suitable to mass affluent market, right? Because very large family offices are risk takers in the debt market, right? What our understanding is they still prefer 15% net to them, which means the fund manager will need to take a 18 to 20% gross, right, risk. Large family offices. So smaller family offices, mass affluent market is what, right, is what our experience have been a lot more comfortable because they are just targeting debt mutual fund plus 400 basis point, but don't take too much risk. So that has been a lot more work, and you will see out from the numbers also. Of the 600 crores, I have 250 investors, which average about 2.5 crores only.
Hmm. The ticket size is decent enough.
Like,
It's nice talking to you, so I get the good explanation of the product, and hope our clients also got all their doubts.
so thanks a lot
Thank you.
to all the team members, and I think Rajesh, who's part of this, and the entire AMC team, we are a very flat organization. We just feel very comfortable. You can just reach out to Rajesh, and I mean, I'm also even a call or a meeting away. If in any case your client feels right that they would want to have a meet and it's a short call, so we're very flattish organization available, right? So just feel free. That's wrong.
Yes, sir. Yes, sir. Definitely. In case we need your help, we will definitely call you up. And it was nice and very informative session. And most of our clients got their doubts cleared on the debt part of it.
Understand.
Thank you, sir.
Thank you. Thanks
Thank
a
you.
lot. Boss.
Thanks.
Thank you.